The markets are taking their victory lap. Traders everywhere are rejoicing. The soft landing is imminent. We're going to be discussing all of that, whether or not we agree or disagree, and much more today on Money Never Sleeps. Welcome back to Money Never Sleeps, everybody. Appreciate you being here with us today. Do us a favor, like today's video, subscribe to our channel if you haven't yet. Even drop in a comment, say what's up, what you want to hear us talk about, any of that good stuff. We are not financial advisors, okay? So I'm going to throw that out there at the top. Please do your own research. We're making any buys or sells. We appreciate it that you come to our show, but we should not be the only resource you use. Kevin, we got victory laps going on. Every trader and their dog is excited because the bull market is back. We are going to all-time highs for everything next year. And, we're going to get 6 rate cuts, not 3. Forget what the Fed said. Double it. 6 rate cuts.
I don't think they're wrong. And that might just be the thing that's like difference between bulls and bears. It's like, yeah, I think we agree on that. But it's just what happens after that is the thing, or what happens during that is going to be a really interesting thing. But yeah, I mean, these markets are absolutely going crazy. Jim Cramer's out here talking about, yeah, Powell, he threw a shot at the Bears, and fucking Jim Cramer was talking on CNBC. I'm like, you fucking donut. I can't wait to dunk on you. I don't like victory lapping at all, but Jim Cramer's one guy. I'm just like, who the hell hired you?
I mean, nothing should be scaring the bulls more than hearing Jim Cramer talking like this. I mean,
I know.
If you were uber bullish and then you heard Jim Cramer going on and on like that, like if you've been paying attention for a while now, you should know that that's not a good sign for your investment thesis. So keep that in mind. Jim Cramer, just counter trade him and you will come out profitable. So I'm going to continue to just I'm going into hibernation right now, man. I'm going to take my cash that I have on hand. I'm going to make a nice warm jacket out of it. And I'm just going to go into hibernation for a few months, and I'm going to emerge victoriously next spring. And I will buy people's bags for cheaper when they are panic selling.
100%. I think that's not a bad idea. Cash, throughout this entire bear market, I've said this because this is the most important thing. Even if you're not making tons of money, your advantage of having cash on hand is going to be so beneficial when this market does finally drop, right? And a lot of people have just blown their wad, their bankroll, it's gone. We know that savings are, a low, even lower than the pandemic at this point right now. We know that credit cards are going extremely high in terms of debt. This doesn't end well for people who are trying to buy, some of these assets when they're extremely undervalued. Right now, everyone's trying to buy at the top. They're chasing this thing, right? And we're seeing a little bit of market volatility today. Very little, nothing crazy, but we got to pivot yesterday. I don't care what anyone says, whether we got the rate cut or not. We know what their outlook is. They're expecting the cut. They don't want to raise, monetary policy. They don't want it to tighten any further. They just want to move on to next year. And this PC data that comes out next week, what happens with Q1, earnings, that's going to be really important for the Fed going forward, even if Q1 doesn't necessarily matter in terms of, or Q4 earnings for Q1 doesn't really matter for the Fed and what they're doing. But this could be a thing where we start to see those rate cuts start to come in, but people don't have the cash on hand to maybe buy some of these stocks. And it really depends on what the market does. And I think we're getting signs of it in the bond market. The bond market is a very scary thing right now, because I could see about 3 trades blowing up just because of what's happened yesterday and what's going to happen going into 2024.
I'm just looking right now at the target rate probabilities and looking at the movement from yesterday to today. More and more people expecting us to get a rate cut as soon as January. That number has gone up to almost 20%. It was at 10% yesterday. Expecting, by March, almost a certainty that we're going to be seeing a rate cut. By May, so it's like this market is getting very, very ahead of itself right now. I get that we're excited and that, but, Powell was fairly dovish yesterday. However, if you look at the data we've seen, let's look at today's data. Retail sales came in over expectation. People are still spending. Meanwhile, jobless claims came in underneath expectations. So, people are not losing their jobs as quickly. And that could be great for us long term. And that could be, a positive for the Fed. It could also be indicating that we know people have less discretionary income. We know that people spending more while having less discretionary spending and wages not increasing at the same rate as inflation right now is not usually a good thing. So maybe I'm crazy. Maybe I'm just looking for the bearish case and the bull one is right in front of me, but I don't think so.
No, fuck that, dude. Those numbers are going to get revised 100%. And we've seen that in the past few months that data has been revised and no one reacts to the revisions. The true numbers in the economy that they say, you know what, actually, this is actually what we are, saying this is what happened in this month or, month over month. They react to the data that comes out in that exact moment, but they don't necessarily think, 2-3 days ahead. And that's just me saying that, their outlook is very limited. And if they are looking, to the future, they're only seeing the good things that could possibly happen. They're not looking at any of the warning signs that the market is flashing right now. I mean, I keep alluding to the bond market, but that VIX trade and a lot of these other things, they're kind of going to unwind if we see what happens when the Fed does start to cut rates. We start to see a sell off in equities, right? We're already starting to see a bit of a sell off in equities in the German stock market. It's been green nonstop for the past few days. Now it's starting to turn around a little bit. So it's a really interesting thing to see how people are getting ahead of themselves. And that might be exactly what this market is doing. It's getting ahead of itself without understanding, okay, why are they cutting rates? They're cutting rates because the economy is slowing down. We're heading into a deflationary period, right? I mean, that's just me, one bear that's been watching the data, trying to make logical sense of what's going on in the world, but not necessarily applying that properly in the markets because clearly the markets are extremely illogical. But I think that at some points, you're on borrowed time at this point in this market. And, maybe a year or so, we're talking about something completely different. Maybe you and I are bullish a year from now, right? But it's not today. I'm just saying that it's not today, not for the foreseeable future, if this tends to play out the way that it has in the past.
Yeah, I think that is very well said. So we went over the latest economic data. I know that you wanted to talk about a few other things. Let's start with the yield curve
Let's do
reinversion
it.
or reversion or whatever the fuck we want to call it. We can talk about the vibe session for a little bit if we want to go
Oh,
on a rant
yes.
there. We don't need to get too crazy with that. But let's talk about yields first because everyone loves bond yields. But more than that, everyone really loves being able to throw out a few terms around it to sound smarter at Christmas dinner. So why don't you wisen the people up for us, Kev?
Absolutely. Well, I mean, let's put it this way. Even with my limited knowledge of everything when it comes to the bond market, I am no Greg Lippman. I know nothing about bonds other than watching their values and how this impacts the prices from other assets and how it's reacted over the course of history. We know that whenever we do get an inversion, which means that the 2 year, the short end of the curve goes higher than the long end. So we're expecting that the yields for the 2 year is a lot higher than the 10 year. And then when that happens, we tend to see a recession does follow, but not before we get a reversion, which it goes back above. In other words, the 2 year yield goes below the 10 year yield and the 10 year remains higher. That's the way it should be, right? If you're lending your money out for a longer period of time, you should get paid more, a higher yield, as opposed to a shorter term duration in which you are lending money out. So now we can just take a look at the history of this. We talked about this on a show a long time ago, but I just want to refresh everyone. This is the period of time in which we saw the inversion happen. So we go underneath this white line, which I'm going to turn that, we'll make that blue for the time being. And when we go below that and to the time we go above it, we tend to see a recession follow. So from time of reversion here back in late 80s is about 19 months before we reverted and then got the recession. It seems that it's in a range between 12 to 24 months. This year is 14 months back in the dot-com bubble. The yield curve inverted and then it reverted. And, from the beginning of the inversion to where the recession began, it was 14 months. Here, 18 months in 2006, which would have been, 2006 to 2007, they started cutting rates. Once it started to revert, recession happened by, November of 2007, which coincidentally also happened to be the top of the market too. So that's something we have to keep in mind for equities too. So once that does revert back to being positive, there's a little bit of worry that we should have when it comes to the 10 and 2 year yield. Now, where are we? This is 14 months. Obviously, it's a lot longer than that. I believe that's in March, it'll be 24 months since they originally hiked rates. I think it was March of 2022, yeah, that they initially hiked rates. And that pretty much means that we're in line of this 12 to 24 months of us eventually seeing some type of, reversion to, being positive, where the 2 year is lower yield than the 10-year yield. And the thing that's scary about that is we got pretty much the markets pricing in right now that we are going to see some trouble going into next year. And the reason I'm saying that is because if we look at the bond market, everything is red right now. I mean, if we look at the 1 month, yeah, it's down 0.34%, but let's look at the longer, the treasuries, 0.38% for the 1 year, 0.81 for the 2 year, which this is going to have to start decreasing faster, but we're crashing below the weekly 50 moving average. We're also below the 200 moving average on the daily. We're going to see a death cross most likely on the 2 year, as early as next week if this continues, right? If we don't get any bounce, that's going to be something that we need to keep an eye on. We're also seeing the 5 year, it's below 4. It's 3.9% right now. Again, below the 50 and the 200 on the daily. 7 year, 3.945, down about 1.82%. 10 year, 2.29%. It was down almost 3.09% at 3.88 earlier today. And then the 30 year, I mean, that's been dropping like crazy. So we're at about 4.05%. Now, the reason I bring this up and why this is important is because think about how many people actually thought that we were going to see higher for longer, that we thought we were going to see inflation continue to rise, right? Not saying the majority of the market was thinking that, but there's still a good chunk of people that were shorting bonds. Now, think of how many people are using margin at this point to maximize profits, right? That's going to be something that really causes a lot of trouble into 2024. We're going to see derivatives and also just margin calls happening everywhere. And I wouldn't be surprised if people were using margin with the bond market. And take a look where we were from October, up here all the way to, where we are now. It's 22% down for the 30 year. I mean, it's about 20 to 21% across the board for most of these above 1 year, the 1 year yields. Now, the thing that's scary about that is if you use a margin, those losses are multiplied and they don't stop, right? Until you start to cover those positions. So now as we're seeing the yields go down, it's telling us that people are positioning themselves in their cash to, lock in some of those yields. They're locking in the 10 years, 5% for 10 years, at the top. That's great. They're doing that in October. Now they're trying to lock it in so that they get a guaranteed rate of return. But the later they go on this, the less of the return they're going to get. Obviously, if it continues to squeeze, more people buy the bonds, this is going to continue dropping like crazy. So that's something that we have to look forward to in 2024. The market's just decided to absolutely tank on this. Now, if people are shorting the bond market and they're using margin, and this continues and they have to cover their positions and we get to short squeeze in the bond market, how is that going to impact equities? Well, first off, we're going to know that a lot of people are going to definitely blow up. Like there's definitely hedge funds and stuff like that that could absolutely just blow up accounts. And that's dangerous because then we're going to start seeing them sell other assets. And if people start selling assets in the stock market, say the S&P, the NASDAQ, any of those stocks, how does that impact the VIX trade? Well, then the VIX gets a little bit more volatile and you kind of get into a thing where the VIX starts doing the same exact thing the bond market's doing. So right now, across the board, this bond trade, I think, is one of the most deadly, scariest things that I'm looking going into 2024 because no one just cares about it right now. And we know that if we are going to start seeing rate cuts, those yields are going to reinvert and we're going to start seeing, these yields drop significantly. And then people are going to be caught with overweight stocks, dashing for cash. The dollar might be down today, but I think that's a short-term thing. It's a very scary scenario, but it's so important and no one's talking about it. Very few people are talking about it, just no one's willing to listen. But something to keep in mind. I'm very, very intrigued by bonds right now. Such a boring thing, but it's so intriguing if it does play out the way.
No one, I mean, talk about things that no one says, like being intrigued by bonds. Like everyone just used bonds as that thing that your grandparents used to give you back in the day, which if you don't give people bonds anymore, like that shit is just so what a waste of money. Never again. But it is something that like if everyone's looking over this way and the real action's over this way, that's the direction I want to be looking at. And so we got to keep our eyes open here. We have to look for clues and not get lazy and complacent like a lot of people are in the market and with their analysis of the market. So I appreciate you bringing that up, Kev. What else do we want to discuss today?
It's up to you. We could talk about Stellantis announcing that they're going to lay off tons of people, which kind of is interesting because the oil market and also everyone coming back from the strikes, what are you doing there in terms of, is that automotive market going to start seeing a lot more pain because there's just not going to be as much demand if oil continues to drop? Do we want to talk about the vibe session, or do we want to talk about BlackRock saying that, you know what, Powell just pretty much gave investors the green lights to buy into the market? All three of
I
those are.
All right, let's talk about the vibe session for a second.
Let's do it.
I think it's garbage. As I've said previously, my opinion has not changed. I think the longer that people like this continue to get platformed, the more financially illiterate the United States is going to be. And you would think that that isn't possible, but it is.
Yeah, I
That's what I have
mean,
to say about the vibe session. It's just so stupid.
yeah, I mean, and again, I think she focused more on human economics as opposed to financial economics. They're talking about what makes people feel happy in the market and the economy, and I'll give her respect for that. But when we're talking about an engineered soft landing and making things seem better than they actually are, and kind of having a political agenda behind it too, I'll say that that is absolutely destructive to people that don't know anything about the markets. You know what I mean? And Bloomberg opinion that continues to platform people like that, or not just them, but anyone. CNBC can do it, Yahoo News or Finance, whatever it is. The more that they put that out there, the more people will read things that they want to agree with. They won't look at things that are important in the markets that should be cause for concern, like the bond market. I mean, I think this is going to cause a huge short squeeze in bonds, and that's going to impact the entirety of the market, and that could destroy so many trading accounts, not just here in the United States, but globally. Now, when I hear vibe session, I think it's just a very, very lazy way of thinking about how the market actually operates. I think it's also pretty indicative of a generation that is hoping things get better when unfortunately it's just not going to get better from my generation, even, generation before me, the younger group part of that demographic. It's going to get a lot worse. I hate to say it, guys, but it just, these things don't play out any other way. This time is not different. For Bitcoin, it is. This time is different. We're not going to see a halving that's as bullish because we're not in such a bullish environment as we were in the previous halvings. But across the board, the yield curve, 7 out of 8 times predicted a recession. This is literally the 8th time we're going to find out if it's true or not. I wouldn't be shitting in one hand, wishing in the other at this point.
All right, let's talk about BlackRock for a second. They're pieces of shit. They're scumbags, and we know that whatever they say is meant for their own good and not the good of anyone else. So, in my opinion, if they're saying that Powell gave the green light, it means they want people to pile in so they can then sell it higher. Because fuck BlackRock, they don't like. At what has gone on? Like them saying that they're getting into crypto has made people be like, oh yeah, it's fine. They're not a giant, like terrible company that's trying to like destroy everyone. Like, fuck no, get out of here with that.
Are you trying to get them confused with the show tunes Blackstone, who put out that crazy video today? Did you see that?
No, but I do feel like if I say anything more about BlackRock that isn't good, I'm gonna get a piano dropped on my head or something.
Yeah, I have nothing to say on that front. All I'll say is more people who are saying that BlackRock's going to buy your Bitcoin. However, now people are believing them. It's like, yeah, we just go balls deep into the fucking market. And I'm like, you guys really just are hoping that things are better. People have to understand you can make money both ways. Yeah, but yeah, I just think that right now that's a top signal across the board. It doesn't have to even be BlackRock that says anything like that. I mean, I think the fact that Deutsche Bank is saying that 5,500 is a possibility for the S&P next year in a bull case, in a base case, I think it was like 52 or something like that. It's like we keep moving the goalposts, guys. But however, the macro eventually is going to catch up with a lot of your statements being air quoted for lies. But we'll see. I think a lot of people are talking their position right now, myself included, obviously, but at least I'm using data and not fucking wishing hopes at this point. So yeah, I think in that front, we're seeing a lot of top signals across the board, and it just doesn't necessarily need to be from talking heads. We're seeing it also in the data with the bond market, and gold itself, I think, is putting in a little bit of a bounce that'll soon be seeing a sell-off. Let's talk about the auto market, because this is really interesting to me. I'm going to share my screen. Stellantis announced they're going to lay off a ton of people. They're not the only ones. I believe there's a company called Cruise that is also laying off people. Yeah, Stellantis announces 3,600 layoffs at Detroit and Toledo Jeep plants. Automakers escalate job cuts under new UAW contracts. Now, here's the thing. These contracts definitely did impact the profitability of a lot of these automotive companies. And it doesn't help that gasoline in oil is dropping significantly, right? We're seeing a bounce today in oil. Obviously, there's going to be bounces, but this doesn't help if demand continues to drop. If there's demand dropped for oil, and people can't necessarily take out loans, and they can't afford these vehicles, because we do know that used vehicles and new vehicles are extremely hard to come by if you're taking a loan right now. The banks are tightening credit, and we start to see just demand in general just drop for oil and gasoline. Well, then what does that tell you? It tells you people are probably not going to be buying some of these vehicles. They probably don't have the cash to buy them. Their credit's extended to the absolute max. And that means that we're probably going to continue to see a lot more layoffs across the automotive industry. So this UAW contract might be great for the short term. How many people will remain at the end of 2000? What, I almost said 2009. Shit, 2025. I know, man. I'm getting flashbacks to 15 years ago, but
You don't even
that
remember
remains to be.
15 years ago. You were like
Oh,
7.
trust. No, dude. I was playing Modern Warfare 2, but I was not 7. How old was I? I was 11. I was 11 years old.
All right,
But
close enough.
yeah. Regardless, I think that the automotive industry is going to see a lot of trouble moving forward, and we saw a lot of stock buybacks from Ford and stuff like that before the blackout window began, and that might be just kind of trying to soften the blow, maybe trying to get out at a higher position, which could be right now. I'm really interested to see how this plays out, but I don't think the automotive industry is in a good place moving forward into next year.
All right, let's wrap it up today. Quick look through any of the charts. It's pretty boring, like for the most part. Like things are fairly flat, at least with like Bitcoin. ETH is up a little bit. We are seeing Bitcoin dominance pull back as some alts going a little bit of a run today. Solana back close to 73. On the TradFi side, monster day for Tesla. They're up over 5%. We could take a look at that.
Yeah.
Let's grab a couple, make it actionable, and then get the hell out of here.
Definitely. So I keep saying this real quick. This is just German economy. DAX, all-time highs. Meanwhile, their manufacturing is in an absolute depression. Just shows you that markets are not correlated always, but we did see a bit of a sell-off at the top. This is a really interesting candle. And I'm not saying that this is a top for this market, but it is a very, very odd candle that we got. We came down, we shot up, and then we just closed, down. It's only 0.08%. But these are kind of signs that you want to see in market moves, because it could be rollover, yes. And if that does start to roll over, people might try and buy back some of that rollover. It doesn't pump as high as they were expecting. People sell out from the next lowest high. You're just forming lower highs and lower lows. Doesn't always mean that we're going to be in a bull flag, but it does mean that maybe the market is starting to roll over. Eventually, these things cannot last forever. And I kind of wanted to preface with that going into where we are currently, because
this is an interesting candle. Things that you're only going to hear on this show and in a Bed Bath & Beyond. Just wanted to throw that out there.
Speaking of Bed Bath & Beyond, no, I'm just kidding. I'm not going to pull up their chart. But yeah, it's this is I guess I like candles. I'll light a candle. I'll light a candle for all the bulls at the end of this cycle. But this is I'll light one for Jim Cramer for saying that the soft landing is here. Soft landing, I'll light you a candle. But yeah, I mean, the S&P, it had a really good day early on, but we're starting to see these really scary wicks. I mean, I don't like this type of candle. That's not what you want to see at the top of a move or after, you get a lot of bullish sentiment. I mean, the stochastic RSI on the daily is 198. So obviously, I mean, even if this does start to roll over a little bit here, it's up on the day. So therefore, there's a good chance that it's probably going to be 100 and 100 by the end of the day. Keep an eye on that going into tomorrow, which is the weekly close. It's kind of weird how things line up like that. So we'll see how people are positioning themselves going in tomorrow. The weekly, again, 98 and 94. Very interesting. Regardless, even if we do see a sell-off tomorrow, this is probably going to close a little bit higher and bring that stochastic RSI. So we are getting to a point where we're extremely overbought. We know that there's a lot of liquidity below us, and we kind of ripped off that Band-Aid across the board of, what's the Fed going to do? When are they going to, cut rates? Now we kind of know. Now the market can kind of price in what they expect moving forward. And by the markets, I mean people with a lot more money than small-time investors. So that's just something to keep in mind. Now let's take a look at Tesla, because the NASDAQ obviously put in the futures market, it put in an all-time high, didn't do so in the NDQ, and then Dow, we talked about yesterday, put in an all-time high, right? But still within this parallel channel. So something to keep in mind. Now, if we look at Tesla, this little Ponzi, I'm just kidding, I'm not shitting on Elon Musk, but it's very interesting to see Tesla because, again, we do know that not necessarily people are buying a lot of Teslas. They also got their government credits. I think that was the news recently, that their government credits being removed, or they're just not giving it to them anymore. So that means Teslas are going to be a little bit more expensive. What does Elon Musk do there, right? Does he raise prices? Does he lower them? I mean, either he keeps them or he lowers them. But that's going to cut into margins once again. So I think Q4 Tesla earnings are really going to tell where this moves forward, because a lot of people are seeing this as a bull flag, which it could be. I think it looks very similar to a bull flag, but could this also be just, A, B, C here, and then this is the beginning of the C wave down? It could. I really don't necessarily know right now. Obviously, if this gets rejected and it goes down further, then I think that we're in the C wave and we're actually heading towards the bottom for this Tesla chart. But for the short term right now, it's up 5% today. I think a lot of this has to do with lags in the top 7. Obviously, this is probably the one that's been lagging the most across the board, and we see that it's the one that's also up today across the top 7. So I think money's just being rotated at the top here. And we look at some of these other ones, we can see Microsoft's not having that great of a day today. It's down 2.48%, $9 or so. So this is this again, very interesting candles that we've been seeing this play out. I'm not saying this is the top whatsoever. I mean, it could push up one more time. We don't want to get ahead of ourselves like some of these other soft landers out there are, but these are not necessarily the greatest types of things you want to see. If we start seeing some bearish engulfing candles on the weekly, obviously we need to watch out a little bit more. But yeah, I mean, these tops can happen very fast, and they kind of happen when everyone kind of gets excited and starts to buy the top. I think a lot of maybe the move going into the end of the year has been priced in. And again, we're talking about a move that's been since the beginning of October, right? Or since October-ish that we got this really nice move up. So let's say from the bottom here to where we currently are, I mean, it's a 17% pump in the course of, maybe a month and a half or so. Is that sustainable? I don't think so one bit. So we'll see how that plays out for some of these bigger caps. Yeah, I mean, across the board, let's take a look at Bitcoin, because I still think that there is a little bit more in the tank for Bitcoin. It also had a really interesting 4-hour candle today. Pull this up. Yeah, you can see the Bitcoin in the shorter time frame. It came all the way down, shot up, and then it had a wick all the way down to 41, came back up, hit all the way up to 43. So we are getting a bit volatile in these smaller time frames. You can't see that necessarily on the daily, but I think there's a good chance that we do have a little bit more room to the upside. I said that just because of liquidations across the board. We talked about that yesterday. What we didn't look at yesterday was ETH liquidation. So I just want to pull that up real quick. But we can see that we're at 22.85. We're up about $25 today. So, crypto is for the most part staying stable at these levels right now. I don't think there's too many buyers or sellers, or if they're distributing, from people who are trying to get out of the market to people who are willing to buy in because they think that we are going to see a soft landing. Things are going to start getting better in the market. Let me pull up the liquidation map and then switch this over. There we go. So we're going to look at the ETH liquidation levels down here. Where am I? There we go. Let's pull up ETH, and then we're going to take a look at the 7-day. And this kind of shows you where a lot of the liquidations are sitting, right? So if we go all the way up to, let's say 24 again, that's about 1.61 billion. If we go down to, say 1983, I think that's the lowest that it goes here. It's 1.63 billion. So it's pretty evenly matched. I don't anticipate, ETH going up higher. It's past like 2,500. Could it? Yes, absolutely. It really depends on how many stable coins can be printed in a single given day. But when I look at this across the board, I think that we're just going to kind of trade within these ranges and liquidate people in both directions. If you look at this on the 30-day, obviously there's a pretty good pile sitting here around 24, 1.37 billion. And I think that if we do wipe that out, people are going to continue going long at that point, and then we're just going to build this pile up a lot bigger, which is putting us around, just short of 4 billion if we get down to 1900. So I think it's very possible we see a lot of volatility going into the weekends, the weekly close for ETH and Bitcoin. Even next week, I think it's going to be volatile to the end of the year. But I think we're in liquidation season until we have a reason to believe that the market is going to make a sizable move to the downside or to the upside, just to play devil's advocate. But I think it is more likely that we do see downward price pressure, given how much people are going long here and how those funding rates have been across the board for all assets. Other things that I've seen in crypto that were pretty interesting. Looks like we had a pretty good move down for KuCoin. Look at this shit. Look at this fucking Ponzi KuCoin, dude. It went from $14 all the way down to $8.90. We're talking about these exchanges, and this doesn't surprise me one bit. We know that KuCoin is a bit of a Tether exchange, not to the extent of Kraken. I mean Tether meaning they have USDT pairs, but a lot of these exchange tokens are no different from one another. They're people who are pretty much just collecting easy money. They have these exchange tokens. They own most of the supply of them. They're trying to dump them. Seems like someone tried to dump a good amount of them on the, let's see, is it the hourly? The hourly chart. Yeah, someone tried to dump a good amount of this on the hourly chart, came all the way back up. It's at $11.65 right now. I wouldn't be surprised if we start seeing this across the board with a lot of other exchange tokens, not necessarily just them, but I don't know. Huobi, I think, has HTX. We know that there's BNB, which we can talk about ad nauseum, but I don't want to anymore. I think that we are definitely seeing a ton of liquidity being drained from this market, and we're starting to see some volatility finally in the alts. It's quiet things like this you need to keep an eye on, even when the prices seem stable for the most part in the big caps.
All right. That is a good way for us to wrap it up. We'll be back tomorrow to close out the week. Another fun week here in the markets. We'll see what happens. I think, short term, the bullishness will continue until there's a reason not to be. It's just a matter of staying ahead of that. So appreciate y'all being with us today. If you have not yet, also Randy, thank you so much for commenting. Always good to see you here, buddy. Hit that like button, subscribe to the channel, drop a comment. All of that good stuff is greatly, greatly appreciated. Same time, same place tomorrow, Knuckleheads. Appreciate you all. Stay safe out there. We'll see you next time.
Take care, everyone.